I've watched people repeat the same mistakes for decades, and the root cause is always the same. They believe the market cares about their opinion. They mistake noise for signal and narrative for structure. The truth, the profound, unyielding truth, is that the market is not a debate club. It is a system, and systems respond to mathematics, not to emotion or conjecture. If you are here seeking a hot stock tip or a prediction for the next quarter, you are in the wrong place. I am here to discuss something far more valuable: the mathematical framework that allows one to systematically extract profit from the apparent chaos of the financial world. This is not about being smarter than the market. It is about being more rational, more disciplined, and more systematic than the competition. It is about understanding the math behind beating the market, where opinions are not just unnecessary, they are a liability. The traditional approach to investing is a flawed enterprise built on a foundation of human frailty. It is an exercise in ego. The analyst reads a report, interviews a CEO, and constructs a compelling story about why a stock should go up or down. This narrative is then filtered through the analyst's own psychological biases, their fear, their greed, their need to be right. They are attempting to model a system with thousands of variables using a few paragraphs of prose and a feeling in their gut. It is an elegant failure. My thesis is simple, and it is proven by decades of empirical evidence. The only sustainable edge in the financial markets is a quantitative, systematic, and short-term one. The market is not perfectly efficient, but it is efficient enough to quickly devour any long-term, obvious inefficiency. The remaining opportunities are tiny, fleeting, and buried deep within the noise. They are invisible to the human eye and inaccessible to human intuition. They can only be detected, exploited, and managed through the cold, relentless logic of mathematics and computation. We are not predicting the future. We are reacting to the present with a speed and discipline that no human can match. We will examine three core principles that underpin this systematic approach. My career began in the world of pure mathematics, specifically in geometry and topology. I was searching for fundamental, elegant structures that govern the universe. I was fortunate enough to contribute to the field with the Chern-Simons form, a concept that describes the structure of certain geometric spaces. It is a beautiful, abstract piece of work. When I transitioned to code breaking at the Institute for Defense Analyses, the focus shifted from pure structure to applied structure. I was still looking for patterns, but now they were hidden in streams of data, in sequences of symbols. The underlying principle remained the same. Structure exists, and mathematics is the tool to reveal it. When I came to the financial markets, I saw the same problem, only with higher stakes and more noise. The market is a vast, complex system, a confluence of billions of decisions made every second. The traditional investor attempts to find a grand, overarching narrative, the story of the company, the macro trend. They are looking for a single, elegant equation to describe the entire universe. But the market is not a single, elegant equation. It is a chaotic system, a high-dimensional space where the signal is infinitesimally small compared to the noise. The error of the narrative-driven investor is one of scale and complexity. They focus on the long-term fundamentals, which are often already priced in, or are too slow to react to the short-term fluctuations that generate the majority of tradable inefficiencies. They are looking for a pattern that lasts for years, when the profitable patterns last for days, hours, or even minutes. Consider the analogy of a weather system. A meteorologist can tell you the general climate of a region that is the fundamental analysis, but they cannot tell you with certainty where a single raindrop will fall next Tuesday. We are not interested in the climate. We are interested in the tiny, localized pressure differentials that cause a momentary gust of wind. These are the statistical anomalies that we seek. The human mind is fundamentally ill-equipped for this task. We are pattern-seeking creatures, but we are biased toward meaningful patterns. We see a head and shoulders formation and assign it a narrative of investor fear. We read a news headline and believe it dictates the price. The computer, however, sees only data points. It sees a correlation between the price movement of a certain commodity and the weather patterns in a specific region, or the frequency of a certain word in news articles. It does not ask why. It only asks, is the correlation statistically significant and is it persistent enough to exploit? This is the core of the quantitative edge. We are not smarter than the market. We are simply better at listening to the data without the filter of human interpretation. We are using the same mathematical rigor I once applied to geometry and code breaking, but now applied to the short-term dynamics of price action. The market is a system of probabilities, and our job is to find the tiny, consistent biases in those probabilities. This requires vast amounts of data, immense computing power, and a team of people who are trained to see the world in terms of equations, not emotions. The psychological cost of narrative investing is immense. It forces the investor to become a pundit, to constantly justify their position with a story. This need for a story is a cognitive trap. When the market moves against their position, the narrative investor does not question the story. They double down on it. They seek out confirming evidence, confirmation bias, and they dismiss contradictory data as temporary noise. They are emotionally invested in being right, which is a fatal flaw in a system that rewards only rational action. The market does not care about your conviction. It only cares about the flow of capital. In contrast, the quantitative approach is guided by the principle of beauty and elegance in model design. An elegant model is one that is simple at its core, yet has profound explanatory power. It is a model that uses the minimum number of variables to capture the maximum amount of predictive signal. If a model requires an elaborate, convoluted narrative to justify its existence, it is likely flawed. The most robust and enduring patterns we have found are often the most counterintuitive, but they are always the most mathematically clean. We seek models that are not just profitable, but are structurally sound, like a well-formed geometric proof. If the math is beautiful, the results tend to follow. The search for structure and noise is a continuous, relentless process. The moment an inefficiency is discovered and exploited, it begins to erode. The market adapts. This is why the traditional investor's edge, a single brilliant insight, is temporary. Our edge is not a single insight. It is the process of continuous discovery. We are constantly building, testing, and discarding models. We are in a perpetual state of intellectual evolution, driven by the cold, hard reality of the data. If a model stops working, we do not mourn it. We dissect it and learn why it failed. The market is a living, breathing mathematical problem, and we treat it as such. The greatest enemy of the investor is not the market. It is the mirror. It is the human being looking back at them, full of pride, fear, and the deeply ingrained need to intervene. When we first began building our systematic trading operation, the most difficult rule to enforce was the simplest: never override the computer. The moment a human hand touches the system, the mathematical integrity is compromised. The system is built on probabilities and statistical edges. It is designed to execute thousands of trades a day, each with a small, positive expectation. The human, observing a momentary drawdown or a counterintuitive trade, feels the urge to stop the bleeding, to correct the error. This is the moment the system fails. Let me give you an example, though not from our own operations, but from a moment of personal failure that reinforced this principle. Early in my career, before the Medallion Fund was fully systematic, I had a small personal trading operation. I had developed a model that suggested a certain trade. I executed the trade, and the market immediately moved against me. The loss was painful, and the human instinct, the fear of being wrong, the desire to preserve capital, screamed at me to close the position. I hesitated, I rationalized, and I finally closed it. Moments later, the market reversed, and the original trade would have been profitable. I had let a momentary emotional reaction override a statistically sound decision. The cost was not just the money lost, it was the realization that my own psychology was the weakest link in the chain. This is why the system must be sovereign. The system has no fear, it has no greed, it does not panic when it loses, and it does not become complacent when it wins. It simply executes the instruction based on the data. The system is the embodiment of rational discipline. This discipline extends to how we manage risk, which is perhaps the most critical mathematical component of the entire operation. We do not rely on vague notions of diversification. We rely on the Kelly criterion or a sophisticated variant of it. The Kelly criterion is a formula that determines the optimal size of a series of bets to maximize the long-term growth rate of capital. It is a mathematical expression of the principle that you must bet more when you have a greater edge and less when the edge is smaller. But you must never bet so much that a string of bad luck can wipe you out. The beauty of the Kelly criterion is that it forces you to confront the reality of your edge. If your model suggests a 51% chance of success, the Kelly formula will tell you precisely how much of your capital to allocate to that trade. It is a cold, unemotional calculation that prevents the two most common human errors: overbetting, which leads to ruin, and underbetting, which leads to mediocrity. The human-driven investor, on the other hand, often bets based on conviction. They become emotionally attached to a stock or a thesis, and they double down when they should be cutting their losses. They are driven by the narrative of their own brilliance. The system, by contrast, is driven by the mathematics of probability. It views every trade as a small, independent trial in a vast experiment. The individual outcome is irrelevant. Only the long-term statistical average matters. The contrast between human and machine decision-making is stark. When a human trader experiences a loss, their brain releases cortisol, the stress hormone. This impairs cognitive function, leading to irrational decisions. They may engage in disposition effect, selling winners too early and holding on to losers too long, simply to avoid the pain of realizing a loss. The machine, however, registers the loss as a data point. It is a variable in an equation, not a personal failure. It continues to execute the strategy with the same precision, knowing that over a large number of trials, the statistical edge will assert itself. The machine is the perfect stoic. This is why we staff our firm with scientists, not traders. A scientist is trained to accept the null hypothesis when the evidence demands it. They are trained to see a model as a tool, not an extension of their ego. The moment a human trader is allowed to intervene, they inject the very biases the system was designed to eliminate. They introduce the noise of their own psychology into the clean signal of the mathematics. The rule is absolute. The system is king. Consider the story of Bernard Madoff. For years, he produced impossibly smooth, consistent returns. My own foundation and family had capital invested with him. I asked one of my most capable analysts to study his reported trades. The conclusion was stark. 80% of his reported profits were a complete mystery. The trades he claimed to be making, buying and selling options to hedge an S&P 500 portfolio, did not mathematically account for the returns. I did not conclude he was a fraud. I concluded I did not understand the mechanism. And in the world of systematic investing, if you cannot model it, you must not touch it. We pulled our money out not because of a moral judgment, but because of a mathematical one. The system was opaque, and opacity is an unacceptable risk. This is the discipline of the quantitative mind. If the math doesn't add up, you walk away, regardless of the perceived opportunity. The removal of the human element is not a sign of intellectual weakness. It is the ultimate expression of intellectual strength. It is a humility to admit that the human brain, for all its brilliance, is a poor instrument for high-frequency, high-volume decision-making in a chaotic system. We use the human brain for what it is best at: building the system, designing the models, and asking the fundamental questions. We use the machine for what it is best at, the flawless, unemotional execution of the strategy. The final principle is the nature of the edge itself. The efficient market hypothesis, the idea that all information is instantly and perfectly priced into assets, is a beautiful theory. But like many beautiful theories, it is only partially true. The market is efficient enough to eliminate the obvious long-term mispricings that a traditional value investor might seek. But it is not efficient enough to eliminate the short-term, transient, and subtle anomalies that arise from the friction of trading, the structure of the market, and the predictable short-term biases of human participants. Our strategy is built on statistical arbitrage, which is the exploitation of these short-term inefficiencies. Imagine two assets that have historically moved together. For a brief moment, one moves slightly ahead of the other. The system recognizes this temporary divergence as a statistically significant anomaly, not a fundamental shift. It simultaneously buys the laggard and sells the leader, betting that the relationship will revert to its mean within a short time frame. The profit on any single trade is minuscule, a fraction of a percent. But when you execute thousands of these trades every day across thousands of different assets, the small, consistent edge compounds into extraordinary returns. This is where the sheer volume of data and the speed of execution become critical. We are not looking for a single powerful signal. We are looking for thousands of weak signals that, when combined and executed with precision, create a robust, diversified portfolio of small edges. This is the mathematical equivalent of finding 1,000 tiny streams of water and channeling them into a single powerful river. Let us examine the mechanics of this in more detail. Consider the concept of mean reversion. Prices do not move in straight lines, they oscillate. When a price moves too far, too fast, it often has a slight, statistically measurable tendency to revert back toward its recent average. This is not a fundamental truth. It is a statistical artifact of market microstructure and human overreaction. Our models detect this overextension and place a bet on the reversion. The edge is small, perhaps only a few basis points, but it is reliable over a large number of occurrences. Another example is cross-asset correlation. We might find that the price movement of a certain currency pair has a statistically significant short-term lead-lag relationship with the price movement of a specific commodity. This is not a relationship you would find in a textbook. It is a fleeting anomaly, perhaps caused by a specific group of institutional traders or a temporary market friction. The human mind would struggle to even conceive of this relationship, let alone track it across thousands of potential pairs. The machine, however, processes the data, identifies the correlation, and exploits the lag with a high-frequency trade. The market's inefficiencies are not static. They are constantly shifting, evolving, and disappearing. The moment a pattern is discovered and exploited, the act of trading on it begins to erode the pattern itself. This is what we call signal decay. The half-life of a profitable signal can be surprisingly short. This necessitates a commitment to constant, aggressive research and development. We are in a perpetual arms race against the market and against every other quantitative firm. To manage this constant evolution, we employ concepts that are familiar to mathematicians and computer scientists, such as hidden Markov models. These models allow us to recognize that the market is not always in the same state. Sometimes it is volatile, sometimes it is trending, sometimes it is mean reverting. Each state has its own set of statistical properties. Our models are designed to detect which state the market is currently in and to adjust the trading strategy accordingly. We do not trade with a single monolithic strategy. We trade with a dynamic portfolio of strategies, each optimized for a specific market regime. This constant need for adaptation is why we hire scientists, not finance experts. A physicist or a mathematician is trained to build models, to test hypotheses, and to discard a beautiful theory the moment the data contradicts it. They have no emotional attachment to the market's history or its conventional wisdom. They only care about the predictive power of the model. I recall an early non-mathematical investment I made with a friend in Bogota, Colombia, a vinyl floor tile and PVC piping company. It was a simple business, capitalizing on a construction boom. The edge was clear: a growing market and a simple product. It was a success. That success was based on a single, clear-cut, long-term fundamental edge. The medallion fund's success is the inverse. It is based on thousands of complex, short-term statistical edges. The lesson, however, is the same. Find an edge, quantify it, and exploit it relentlessly. The difference is that in the modern market, the edge is no longer found in a simple business plan. It is found in the higher order mathematics of market microstructure. The final component of this systematic evolution is the collaborative environment. Our research meetings are not about debating the future of the Federal Reserve. They are about presenting a new model, a new anomaly, a new way to combine existing signals. The code is open, the data is shared, and the criticism is brutal and purely intellectual. Collaboration accelerates the rate of discovery. By surrounding yourself with the smartest people who are all focused on the same mathematical problem, you ensure that your system is always evolving faster than the market is eroding your edge. The principles I have outlined, the rejection of narrative, the discipline of the system, and the relentless pursuit of statistical edge are not just for trading. They are a framework for rational decision-making in any complex system. If this discussion has resonated with the logical part of your mind, I ask you to do two things. First, engage with this content. A simple like is a data point that helps this message reach others who value logic over emotion. Second, and more importantly, leave a comment below. Write a single, concise sentence about how you will apply the core lesson of removing opinion and embracing system to one area of your life, whether it is your finances, your career, or your personal decisions. To summarize the mathematical path to success, first, accept that the market is a chaotic system of probabilities, not a story waiting to be told. Your opinion is irrelevant. Only the data matters. Second, build a system, a set of rules and algorithms that is immune to your own psychological biases. The discipline of the machine is superior to the emotion of the human. Third, focus your energy on the continuous, systematic discovery of small, short-term statistical anomalies. The edge is not found in a single grand insight, but in the aggregation of thousands of tiny, consistent biases. The goal is not to be a genius. The goal is to be a rational, systematic, and unemotional extractor of statistical advantage. This is the math behind beating the market. This is the only way to build lasting financial success. Let us delve deeper into the concept of predictive modeling. In the world of mathematics, we often speak of the difference between a model that is overfitted and one that is robust. An overfitted model is one that describes the past perfectly, but fails to predict the future. It has captured the noise, not the signal. In the financial markets, the temptation to overfit is constant. With enough computing power, you can find a pattern in any random sequence of numbers, but that pattern is a ghost. It has no predictive power. To avoid this, we use rigorous statistical techniques, such as out-of-sample testing and cross-validation. We build our models on one set of data and test them on another. If the model fails to perform on the unseen data, it is discarded, no matter how beautiful it appeared on the training set. This is the scientific method applied to finance. We are not looking for what was, we are looking for what is likely to be. The importance of data quality cannot be overstated. In the early days of Renaissance, we spent an enormous amount of time simply cleaning and organizing data. We realized that if the input is flawed, the output is worthless. We sought out data from every conceivable source, not just price and volume, but weather patterns, shipping manifests, and even the frequency of certain words in news reports. We were looking for the subtle, hidden connections that the human mind would never think to look for. This is the power of the quantitative approach. It allows you to see the world as a vast, interconnected web of data points, where everything is potentially a signal. Consider the role of market microstructure. The market is not a smooth, continuous surface. It is a granular, fragmented landscape. Every trade has an impact. Every order leaves a footprint. By understanding the mechanics of how orders are matched and executed, we can identify tiny, fleeting inefficiencies that arise from the very structure of the exchange. This is the level at which we operate. We are not interested in the grand movements of the economy. We are interested in the tiny, microscopic fluctuations that occur in the milliseconds between trades. This is where the math is most powerful and where the human element is most irrelevant. The concept of risk management is often misunderstood. Most people think of risk as something to be avoided. We think of risk as something to be measured and managed. Every trade has a risk-reward profile. Our goal is to build a portfolio of trades where the aggregate risk is minimized while the aggregate reward is maximized. This requires a deep understanding of correlation. If all your trades are correlated, you are not diversified. You are simply betting on the same thing multiple times. We use sophisticated mathematical models to ensure that our signals are as independent as possible. This allows us to achieve a level of consistency that is impossible for a human trader to replicate. The philosophy of continuous improvement is the heartbeat of our operation. We never assume that we have solved the market. We know that the market is always changing and that our edge is always eroding. This is why we invest so heavily in research. We are constantly looking for new signals, new data sources, and new ways to refine our models. We are in a perpetual state of dissatisfaction. If we are not getting better, we are getting worse. This is the reality of the quantitative arms race. The collaborative nature of our work is a key part of our success. In many firms, traders are pitted against each other, competing for bonuses and prestige. At Renaissance, we work as a single team. Everyone is incentivized to contribute to the success of the entire firm. This creates an environment where ideas can be shared and critiqued without ego. It allows us to leverage the collective intelligence of some of the smartest people in the world. This is the power of a unified system. The rejection of human intuition is perhaps the most difficult lesson for most people to learn. We are taught from a young age to trust our gut, to follow our instincts. But in the world of high-frequency trading, your gut is your worst enemy. Your instincts are tuned for survival on the savannah, not for navigating the complexities of modern financial markets. They lead you to see patterns where none exist and to react emotionally when you should be acting rationally. By surrendering to the system, you are not giving up your intelligence, you are amplifying it. You are using your intelligence to build a tool that is far more capable than you are. The final thought I want to leave you with is the idea of intellectual humility. The market is a vast, complex, and ultimately mysterious system. We can never know everything about it, but by using the tools of mathematics and science, we can uncover small, consistent truths that allow us to navigate it with a degree of success that is otherwise impossible. This is not a path to certainty. It is a path to probability. And in the end, probability is the only thing that matters. The pursuit of mathematical beauty in our models is not just an aesthetic choice, it is a practical one. A beautiful model is one that is robust, scalable, and deeply grounded in the reality of the data. It is a model that can withstand the noise and chaos of the market and still deliver a consistent signal. This is what we strive for every day. We are not just traders. We are scientists, explorers, and mathematicians. We are searching for the hidden structure of the universe, one data point at a time. The discipline of the system is what allows us to survive the inevitable periods of drawdown. Every strategy, no matter how good, will have periods where it loses money. This is a statistical certainty. The human trader in these moments is tempted to change the strategy to fix what is broken, but the systematic trader knows that these periods are part of the process. They are the cost of doing business. By sticking to the system, we ensure that we are there to capture the gains when the market returns to its normal state. This is the power of long-term thinking in a short-term world. The role of technology in our success is undeniable. We use some of the most powerful computers in the world to process vast amounts of data and execute trades in milliseconds. But technology is just a tool. The real power lies in the mathematics that drives the technology. Without the right models, the fastest computer in the world is just a very expensive paperweight. This is why we focus so much on the intellectual side of the business. We are not just building faster machines, we are building smarter models. The final lesson is that success is a process, not a destination. It is the result of thousands of small, disciplined actions taken every day. It is the result of a commitment to logic, mathematics, and the rejection of emotion. It is the result of a willingness to be wrong and a relentless drive to be right. This is the math behind beating the market. This is the Jim Simons way.